Hi, I'm Peter Rose, founder of Longwood Currency Trading. How to lose a lot of money trading Forex. If you're not having the success that you think you should be, or you're losing a lot of money, it could probably be because of one thing, and that has to do with risk management. Now, I've done other videos where I've said that one of the greatest mistakes that you can make is not getting out. You got to get out of a position that's going against you. You have no idea of where it's going to go on the plus side or how far it's going to go, but if you can lock down that loss point, you do have to know how to trade, because if all you do is a short stop, you're going to hit it all the time, and you're not going to do anything because you don't have anybody to show you how to learn from those mistakes. But it's a lot cheaper education to get whacked small like that than it is to set your stop out 20 pips, 30 pips, 50 pips, or whatever it is that you're doing, and taking those hits and then trying to think you're going to make your money back. You know, if you lose 50% of your money, it'll take you 100% return on your remaining 50% balance just to break even. Think about that before you go taking these long stops. But that's not the whole story. The whole story isn't just getting out. The whole story is, what are you trying to accomplish in your trading? You may be trying to make too much money by trading for too many pips. And the only way you can trade for too many pips, more than likely, is you do what a lot of the advice on the YouTube channel says. It's so safe up on the daily candle, trade on the daily candle, go in at 5 o'clock at night on the close, or whatever your closing time is. I'm East Coast US, and this is early November of 2023. In any event, trading off the daily candle. Well, the daily candle, if you're trading the majors, has an ATR of anywhere from 80 to 120 pips. That's a big spread, but that's what we're seeing in the currency markets. So what are you going to do? You're going to set 2 ATR, you're going to set your stop at 200 pips because you're trying to get 200 pips, or all this ridiculous advice that's going on out there. If you're trading off the daily candle and you're trying to make 10 or 20 pips, you're wasting your time. You should be down on the shorter time frames just picking away at it. What I've found in how to lose a lot of money very quickly is to do a carry trade, to do that, to trade on that daily candle, or pick your profit targets off of the daily instead of down on a 15-minute like I do. I'm a day trader. I want to be out in 2 hours. I want to get my trades done and get done with trading and close it up. I don't want to sit there at my desk for 6 hours. Who's got time to sit at their desk for 6 hours? You know, if you're doing anything other than day trading, you're going to be carrying those trades over, looking for the 100 pip or the 80 pip gain on your money. So where are you setting your stop? And if you happen to be in a trade like that, and all of a sudden you get a news release that comes out, CPI, non-farm payroll, the president just got diarrhea, whatever the news is, and all the retail traders swoop in and bid the price up or down or whatever it's going to be, and you're on the wrong side of that, all of a sudden now, if you don't have your stop set, you're 70, 80, 90 pips underwater in a heartbeat. You know, I'm just looking at the chart today, and we had a CPI release in the U.S. It was weak. Inflation is getting under control, and so the dollar is just getting sold off like cheap soup. Really? At some point it's going to come back. But it's gone, I don't know, 150 pips in something like an hour and a half, 2 hours. And this is the middle of the day in where I'm at, East Coast time. You're going to be at work. Are you going to be there to manage that trade or to get out? If you're trading long term, are you going to crawl your stop a short distance? That's not the way that the theory that they're teaching you to do. And so I think that if you would reevaluate whatever methodology it is that you're trading now and look at it in a shorter time frame, let's get done with this in a 2-hour time frame. then you're not going to get caught with a carry trade. You're not going to get caught with the release of news because, oh, I'm going to be trading at 7:30 to 9 o'clock on a Thursday of the month when non-farm payrolls come out. I can sit on the sidelines until they open and see where the volume is going, jump in, pick up 20 pips, and as soon as it starts to stagger a little bit, get out if you want to play that. You want to play those. Most advice, most people say, don't trade them. I trade them. But I understand order flow and price action and stuff like that. I can maybe get away with that most of the time. Sometimes I don't. Most of the money I've lost has been because I may know where the price should go, but in the interim I get stuck because it moves radically in the opposite direction for the only apparent reason is that a bunch of retail traders are falling prey to whatever the news release is. The institutional traders are not. They're not trading against you. They're looking for liquidity to satisfy their client orders. So if y'all are getting in long, they're going to facilitate that. They're just going to sell that other pair and they're going to go long with you. And they're going to keep going and keep going and keep going, and everybody thinks, oh, everybody's going that way, and you're all going to get in. We're only 10% or 15% of the market. It's 15% of the market. Retail traders, back when I started looking at this stuff, 2007, when it was a $4 trillion a day market, it's a $7 trillion a day market. I doubt very seriously that the retail traders are 15% of that. So maybe 10%, 8%. I don't know what it is. Whatever it is, it's not very big as a percentage. But if you've got 8% of the volume going on, you can push a lot of shit going. And the retail traders are just looking at that going, yeah, we need that liquidity. Because as soon as it tops out and gets done with the craziness, it's going to flip around and go in the opposite direction. But long after you've had to tap out on either a margin call or you just tapped out through the flag on the field. Don't listen to what these people are telling you out there in video land about how safe it is to trade. If you're trading large account size, or you have a large account size, and you're trading small, then it doesn't make any difference. You can do that. But if you're trading a full lot or 5 full lots or something like that, that's not something you want to screw around with, because if you lose 60 or 80 pips, it's a big chunk out of that money. I've traded a mid-six-figure account. So I could lose 80, 90, 100 pips and ride that through, and the size that I'm at doesn't necessarily, it's a lot of money, but in relationship to the size of the bank I have, it's not. And so I'm just playing it at a higher scale, just like the poker players. You can play nickel, dime, quarter, and you can get wiped out, or you can, as you get better and you have a larger bank, you might have $1,000 in your bank. Now you play nickel, dime, quarter, and you're going to be more successful because you've got more staying power, and you can take those risks and still not lose your account. But most people don't know how to trade that way, and so if you're not learning the proper process of trading itself, you're going to have a hard time figuring out what to do when you're going with these positions overnight and how to calculate how much money you're going to make. Oh, I'm going to carry this trade over. I'm working on a daily candle, ATR of 80 pips, so I'm looking for a full day. This thing is going to go up 80 pips, and so my profit target's 80 pips up, and I'll put my stop at the bottom of this candle. Really? So price goes up 40 or 50 pips, and you think you're great, but you're not looking at the charts because you're set and forget. You come in the next day and your 80 pip stop got hit because the price turned around, didn't go 80 pips in your favor, it went 50 pips, and then it turned around and went 80 pips down, and then took another 30 and took your stop out. And what you end up with is two candles that are together that end up with a little tail at the top, and those can be pin bars at a certain point. If you don't understand order flow, you should not be trading up on the higher time frames, because those are dependent more on the fundamental news and everything else that's going on that you can't react to fast enough, and you can't predict It's far more dangerous, in my view, than losing 5 pips or 10 pips on a couple of times on a short stop and going, this isn't going my way today. I'm just out. I've lost a couple of $1,000 and I'm good with that. Or my target that I was shooting for might have been, you know, $6,000 or whatever. But it's not a risk to reward thing. I don't play that shit. That doesn't make any sense. As a guy with a degree in physics and almost a minor in math, I'm just here to tell you that risk-reward thoughts are counterproductive to what you're doing, and they are incorrect. In fact, the whole concept of stating it as risk-reward is incorrect. It's reward to risk that gives you a ratio that's a whole number that, or a number that gives you a different visualization of what the market is doing. But it doesn't help you with your trading. What are you going to say? Oh, I'm going to take a 10 pip stop, so I'm looking for a 30 pip gain because I'm looking for a 3-to-1? Come on. You're going to be out of your mind. It's that kind of thought process that causes you to look for more pips than the market is going to give you in one move. You're trying to play a trend game in currencies, and you can't do that because of the retracements. Because there's an economic reason that you get the retracements in the currency market that you don't get in the stock market. So you listen to a bunch of buffoons that come out of the stock market because they were unsuccessful there, and they're trying to trade in the currency market the same way, and they're losing all their money and they're getting wiped out because they're trading at 200 or 500 to 1 leverage. And then all of a sudden, statistically, they're going to get it right 6 times in a row. If you take a $10,000 or $20,000 account and you are trading that at 200 to 1, 500 to 1, you're going to end up with a 6-figure account in 6 statistical hops in the direction you're going. So you're not trading. You just got lucky on a statistical probability. I mean, these folks out there that you're listening to do not know what they're talking about, and the ones that do well using proper methodology to how to trade they don't know how to teach it. They don't know how to reflect it to you. So they say, oh, well, I got in because the Bollinger Band did this and the RSI was here and it was Tuesday, and so that's why I got into the trade. They're talking about a system. They didn't make that trade based on a system. They validated their trade on the system. There's a big difference to that. And if you don't understand that, you're going to lose a lot of money trading Forex. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.